Olivia Bono-Voznenko for Modern Wall Street. And look what I spotted. It's a Stephen Guilfoyle. Little known enemies and praise on the macro. Hey, Sarge, how's it going? Welcome to the show.
Not too bad. Glad to be here, Olivia. Thank you for having me.
You're welcome. Now, what a macro day it's been. Retail sales, industrial production. What happened?
Well, they were lousy. I mean, retail sales were lousy not only at the headline but at the core. Now, the core has been stronger than the headline going back over several months, so this is really a disappointment, I think, for the Federal Reserve, for the U.S. economy in general. Industrial production, always kind of a sloppy number. We never really know how it's going to come out. We did expect contraction, not this much contraction, but we did expect contraction this month. The scary thing there is we've only had about 4 positive reports for industrial production over the last 13 or so months. And in all 4 instances, the next month they were revised lower. So even our good reports weren't as good as we thought at the time they were released. And then you want to go back over the last month or so, we've had lousy ISM numbers for services, for manufacturing. We've had a lot of, outside of really real estate, we've had a lot of lousy macro, really for the summer. And that was on top of a lousy first half. So the FOMC finds himself in a tough spot.
Yeah, the Dow jumped 200 points. It's interesting to see how the markets respond during the Fed's blackout period. How do you interpret this?
Well, see, there's a lot of moss on the tree right now. I mean, we have an S&P rebalance tomorrow. You know, they're rebalancing several of their indices. And we also have quadruple witch, and the REITs become their own sector tomorrow. So there may be quite a few things moving around there as well. Today, all 10 sectors were in the green. Tomorrow, there'll be 11 sectors to look at. So there's a few things moving around underneath the surface here. So yeah, we had a nice day today, a little bit of a recovery from what we've seen earlier in the week and last Friday. But how much of that will be sustained through tomorrow? It's really almost anybody's guess, because tomorrow night's close will be a significant event, both volume-wise and maybe price-wise.
All right, Sarge. Well, for the first time here on Modern Wall Street, we have a viewer question for you. Are you ready?
I will do my best.
All right. It is from Donna and Mike from North Carolina. North Carolina, oh my stars. All right, here we go. Donna and Mike, they want to know, with a short-term horizon, about 5 years, what % of a retirement portfolio should be in a total bond fund? We'd like to know where Sarge sees the market for the remainder of the year. Is current volatility just a correction or a trend?
Let's start and work backwards. The current volatility is probably something of a trend that you'll see for a little while now, because we had such an extended period of a lack of volatility, and now the central banks are being heard from again. Mark Carney and the Bank of England didn't do much today. We expected that. Mario Draghi and ECB kind of held their brakes last week because they knew the BOE was up this week. They may have to ease going forward. We'll see about that. The BOJ is going to do something funky next week, all right? They're probably going to try to steepen their yield curve from what we're reading, which means, but still they might try to push the short end of the curve further into the negative, which means they're going to try some kind of operation twist, kind of like what we did several years ago, but almost in reverse. So the Bank of Japan is probably going to do something that will rattle the markets next week, and the FOMC, I think their hands are tied at this point. The macro is too weak to do anything. If they were to force it and vote for a hike at this time, even though at heart I am kind of a hawkish guy, I think that would really be almost as if they were under orders from someone else. I don't think any kind of sentient economist would make that decision at this point. That said, bonds, I'll tell you what I do. I don't want to tell them what to do because that can only get people in trouble. I typically maintain about 17.5% of my portfolio in bonds, and I concentrate on treasuries with that. I probably, not that I'm doing it yet, but I'm seriously thinking about dropping that down to 15%. I wouldn't get out of them completely, because every time in the past when I have thought about getting out of bonds because the Federal Reserve was going to raise rates, I have been fortunate that I dragged my feet a little bit and did not make that decision.
All right, well, thank you so much, Sarge. It's the end of the day. I say you and I make like a stock and split, and I'll see you next week.
How many ways are we going to split?